Accounting is the language of business, and Warren Buffett believes that you shouldn't invest in stocks unless you are willing to put in the effort to understand financial statements. If you don't know how to read and interpret a balance sheet, by the end of this video, you will understand its key points and how it shows the company's competitive advantage. If you stay until the end, I'll share with you 4 key ratios to check if the company you want to invest in is healthy. So let's dive in! Finance is like a language that shows how a business is doing, and financial reports are its stories. When you invest in a company, its financial statements show you how well the business and its industry are doing. If you invest in a company without understanding its financial numbers, you are more likely to make a bad investment. So the question is, how do you read and understand a balance sheet like a value investor? The balance sheet is one of the key 3 financial reports, along with the income statement and the cash flow statement. The income statement measures the profitability of business during a specific time, like a month, a quarter, or a year. The cash flow statement tracks how cash moves in and out of a company during a specific period. The balance sheet provides you a snapshot of the company's financial health at a specific date. Its basic structure is as follows. Assets will always equal liabilities plus shareholders' equity. Assets is what the company owns. Liabilities is what the company owes to its lenders and other creditors. Shareholders' equity is what the company actually owes to its owners after all debts are paid. Conceptually, a balance sheet is a net worth statement for a business. This is the balance sheet for Tom's Toy Factory, an unimaginary public company traded on the stock market. Assets on the left and liabilities and shareholders' equity on the right balance each other out, meaning they total the same amount. That's great, but what exactly does this balance report show? Let's look at the line items for each of those 3 areas. The assets on Tom's Toy Factory's balance sheet are divided into current assets, fixed assets, and other assets. On a balance sheet, assets are listed based on how quickly they can be turned into cash, and the assets that can be easily converted into cash are shown first. Current assets are those that are either cash or expected to become cash within the next 12 months. Cash and equivalents are exactly what they sound like. It's the money Tom's Toy Factory has readily available, including cash on hand, money in bank accounts, and highly liquid assets that can quickly be converted to cash. A public traded company on the stock market has 3 ways to build a large stockpile of cash. It can sell new bonds, issue new stocks to the public, or take out on a loan through a financial institution. A bond is a loan that an investor gives to a company or government, and in return, they promise to pay the investor back with interest after a certain period. A stock is a small piece of ownership in a company, and when you buy a stock, you own part of that company and can earn a portion of their benefits. 2, it can sell an existing business or assets, like a building that the company owns. 3, it has an existing profitable business that makes more money than it spends. It is the third scenario that catches the eye of value investors, because a company that makes a lot of cash from its operations likely has a durable competitive advantage. Value investors often focus on companies facing short-term issues that cause other investors to sell their stocks. When they become interested by those companies, they often check if the company has ample cash and minimal debt to survive their current challenges. When they see a lot of cash and equivalents and minimal or no debts, chances are high that the business will navigate through tough times smoothly. When the company has limited cash and a huge amount of debts, it's likely a sinking boat that even the most skilled manager cannot save. A simple way to find out what is generating all the cash is to look at the balance sheets from the past 7 to 10 years. This will show if the cash was generated by a one-time event or not. Comparing it with the company's competitors will show if this is a company-specific achievement or an industry-wide trend. Accounts receivable is the money Tom's Toy Factory's customers owe for products they have received but have not paid for yet. Customers are expected to pay for those sales within a short time, usually 30 to 90 days. Below that, the allowances for bad debts is the money set aside for sales on credit that probably won't be paid back and will be written off. Any company that sells on credit faces the issue because some customers don't end up paying for the products or services they received. This account reduces the total amount of accounts receivable. Inventory is the value of raw materials like plastic or paint, work in progress toys partially assembled, and finished toys ready to be sold. Prepaid expenses are unusual current assets that won't be turned into cash in most cases. Those are expenses that have been paid in advance and won't need to be paid again. For Tom's Toy Factory, this includes things like annual insurance, which will be used up over time. The total of your cash and equivalents, accounts receivable, less allowances for bad debts, inventory, and prepaid expenses gives you your total current assets. We'll soon see the importance of this number by comparing it to another number in the liabilities section. Every company buys physical assets like computer, manufacturing equipment, buildings, land, trucks, and more to conduct its business. Those assets are used for many years and are not considered current assets. They are called fixed assets or property, plant, and equipment. Those fixed assets are recorded at their original cost on the balance sheet. During their use, their value declines often to zero by the end of their useful life, except for land. To account for this decrease in value, a company will gradually reduce the cost of each fixed asset over its useful life in the business. If Tom's Toy Factory buys a truck for $10,000 to deliver its toys and its useful life is 5 years, the company will depreciate $2,000 each year for that truck. Each year, the depreciation expense of $2,000 will be shown on the income statement as an expense. The accumulated depreciation shown on the balance sheet is the total depreciation recorded for all fixed assets since they were bought. Value investors are often interested in companies that don't have to spend a lot of their profits on updating their manufacturing facilities to stay in business. When a company has a durable competitive advantage, it doesn't need to continually upgrade its plant and equipment to remain competitive. For example, See's Candies, one of Warren Buffett's best investments, built a candy making plant and does not need to update its plant and equipment until it wore out. Companies like General Motors has to regularly update its entire factory when introducing new car models, which limits its ability to use profits for growth or to give it back to its shareholders. Creating a consistent superior product that doesn't need extensive manufacturing changes results in consistent superior profits. At the bottom of the asset side of most balance sheets is a catch-all category. Those are valuable items that don't fit in the current assets or fixed assets categories. For example, a deposit paid to a landlord for leasing Tom's Toy Factory's head office would appear under other assets. Investments in other companies would also be listed here. As a value investor, a company's long-term investments can reveal a lot about the investment mindset of its top management. Do they invest in businesses with a durable competitive advantage, or do they put large sums into poor businesses just because they believe bigger is better? If you notice many investments in other companies that don't make sense, it can raise doubts about the top management's ability to allocate the company's financial resources wisely. Tom's Toy Factory's balance sheet divides its liabilities into current liabilities and long-term liabilities. Liabilities are listed based on how soon the cash will leave the business. Current liabilities are debts the company expects to pay within the next 12 months, which matches the period in which current assets are expected to turn into cash. We'll discuss their relationship shortly when we look at key ratios to assess a business health. Accounts payable are what Tom's Toy Factory owes to its suppliers for goods or services it has received but not yet paid for. Those are items like paint, electronic components, packaging, or other essentials used to manufacture toys. Amounts in this category should be paid according to the trade terms printed on the invoices, typically within 30 days. Next on Tom's Toy Factory's balance sheet is the accrued payroll account, which is the money the company owes to its employees for work they have already done but have not been paid for yet. Since employees are usually paid for time already worked, not in advance, almost every company has amounts of wages earned by employees but not yet paid out. Just as Tom's Toy Factory records its payroll earned but not paid yet, they have other similar liabilities. Those are recorded in the other accrued liabilities category and could include a large purchase made from a supplier that Tom's Toy Factory has not been invoiced for yet. Income taxes payable is the amount of money the company owes in taxes for its earnings but has not paid yet. Short-term debt is the money that Tom's Toy Factory has borrowed and must repay within a year. The current portion of long-term debt is the part of the long-term debt that must be paid within the next year. If Tom's Toy Factory borrows $600,000 over 6 years and must pay $100,000 each year, the $100,000 will be classified in this category. Value investors often believe that companies with a durable competitive advantage need minimal or no long-term debt to sustain their business operations. Those companies have often minimal or no long-term debts that need to be repaid. With an average or poor company that is experiencing serious problems, too much debt coming due in the current year can lead to cash flow issues and potential bankruptcy, which also means losing your investment. The sum of accounts payable, accrued payroll, other accrued liabilities, income taxes payable, short-term debt, and current portion of long-term debt gives you your current liabilities. Lease purchase contracts are agreements where a company rents an asset with the option to buy it later. Those contracts show the value of the lease payment and the potential buying cost. Those are things like machines used to make toys or storage facilities for keeping Tom's Toy Factory's inventory. Long-term debt, excluding leases, is money that Tom's Toy Factory owes and plans to repay over a period longer than 1 year. The entire loan amount is reported as long-term debt, with the portion due to be paid within the next 12 months shown in the current liabilities section. As mentioned earlier, value investors often believe that companies with a durable competitive advantage have minimal or no long-term debt on their balance sheets. This is because those companies are so profitable that they can finance their expansions or acquisitions internally without the need to borrow a large amount of money. The sum of leases, purchase contracts, and long-term debt other than leases, minus the current portion of long-term debt, constitutes Tom's Toy Factory's long-term liabilities. Tom's Toy Factory's shareholders' equity includes preferred stock, common stock, contributed capital, retained earnings, and treasury stock common. Preferred stock is the type of ownership in Tom's Toy Factory that provides fixed dividend payments to shareholders and gets paid before common stock if the company goes bankrupt. They do not have voting rights to elect the board of directors, which in turn hire a CEO to run the company. Common stock is a type of ownership in Tom's Toy Factory that gives shareholders voting rights and a share of the profits, but they get paid after preferred stock if the company goes bankrupt. Both preferred stock and common stock are reported on the balance sheet at their face value. This means it's usually a small part of what investors actually paid for legal reasons that are too complicated to explain in this video. Let's just say that investors usually pay more for a share of stock than the amount under those two labels. The difference between the real price and the amount shown under those two labels is reported under the contributed capital category. At the end of the day, a company's net earnings can be paid out as dividends to shareholders, used to buy back the company's shares, or retained to help the business grow. When earnings are retained in the business, they are added to the retained earnings category. Retained earnings are an accumulated number where each year's new earnings add to the total from previous years. If the company loses money, the loss is subtracted from what the company has accumulated in the past. If the company loses more money than it has earned during its lifetime, the retained earnings number will be negative. If a company is not adding to its retained earnings, it is not increasing its net worth. If it's not growing its net worth, it's unlikely to make you super wealthy over the long run. Value investors are very interested about the rate of growth of a company's retained earnings because it's a good indicator to show if the company has a durable competitive advantage or not. Treasury stock common is the company's own common stock that it has bought back from shareholders and now holds. When a company buys back its own stock, it can do two things with them. It can cancel them or keep them for potential reissuance later. If they are cancelled, they cease to exist. If kept for potential reissuance later, they are recorded on the balance sheet. Companies with a durable competitive advantage, due to their strong financial performance, often have a lot of free cash that they can use to buy back their own shares. One of the hallmarks of a company with a durable competitive advantage is having treasury shares on the balance sheet. Treasury stocks can also significantly influence one of the most important ratios that value investors consider. Several ratios based on the balance sheet help value investors to measure the health of a business. The current ratio measures a company's ability to cover its short-term bills with its short-term assets. It shows whether a company has enough resources to pay off its debt in the near future. The current ratio is calculated by dividing a company's current assets by its current liabilities. A ratio above 1 means the company has more assets than liabilities, so it can cover its short-term debts. A ratio below 1 means the company has more liabilities than assets, so it might struggle to pay its short-term debts. With $5 million in total current assets and $2 million in total current liabilities, Tom's Toy Factory has a current ratio of 2. The debt to equity ratio measures how much a company relies on borrowed money versus its own fund to finance its operations. It shows how risky or safe the company's financial situation is. The debt to equity ratio is calculated by dividing its total debt by its total equity. A ratio above 1 means the company has more debt than equity, which can be risky. A ratio below 1 means the company has more equity than debt, which is safer. With $3 million in total liabilities and $7 million in shareholders' equity, Tom's Toy Factory has a debt to equity ratio of about 0.43. Value investors often believe that a company with a durable competitive advantage will use its profits to fund its operations. If this is the case, those companies should have higher shareholders' equity and lower total liabilities. Companies with strong earnings sometimes buy back their own stock, which reduces their equity as they end up with less retained earnings. This increases their debt to equity ratio, making them appear like an average business, which doesn't reflect their true financial strength. By adding back the value of treasury stock common that companies acquired through stock buybacks, it ends up showing a better debt to equity ratio. The return on equity ratio shows how well a company uses shareholders' money to make profits. The ROE ratio is calculated by dividing a company's net income by its shareholders' equity, then multiplying the result by 100 to get a percentage. To calculate a company's ROE, you need data from both the income statement and the balance sheet. I've recently made a video about how to read and interpret an income statement, and if you are interested about it, you can find it in the description. A higher ROE indicates that the company effectively generates profits from shareholders' investments. For example, an ROE of 15% means the company makes $15 of profit for every $100 of shareholders' equity. A lower ROE means the company is less effective at generating profits from shareholders' money. If Tom's Toys Factory has a net income of $700,000 in 2023 and shareholders' equity of $7 million, their ROE would be 10%. A high ROE can sometimes be artificially inflated from one year to the next by a company. If Tom's Toy Factory decides to retain its earning of $700,000 in 2023, its shareholders' equity will increase to $7.7 million. To get the same 10% ROE with a $7.7 million in shareholders' equity in 2024, Tom's Toy Factory needs to generate at least $770,000 in net income in 2024 compared to $700,000 in 2023. Some companies might choose not to increase their shareholders' equity by paying dividends to their shareholders or buying back their own stock with the profits instead. They can also try to boost their earnings by borrowing money to fund initiatives or buy businesses that will positively impact their net income. If Tom's Toy Factory decides to buy another toy company in 2024 that earns $1 million in profits entirely through debt financing, its earning would increase to $1.7 million. However, its shareholders' equity would remain at $7 million, resulting in an ROE of almost 25% in 2024. Value investors prefer to focus on return on invested capital instead of return on equity, which is a better number. Return on invested capital, ROIC, tells how effectively a company generates return from all capital invested in it, including both equity and debt, as well as dividends and share buybacks. ROIC is calculated by dividing a company's net income by the total capital invested in it, which includes shareholders' equity, long-term debt, dividends paid, and treasury stock comment converted into a positive number. The dividends paid to shareholders can be found in the cash flow statement. Let's assume that Tom's Toy Factory did not pay any dividends in 2023. With a net income of $700,000, shareholder equity of $7 million, long-term debt of $500,000, and positive treasury stock comment of $500,000, the return on invested capital will be around 9%. It is 1 percentage point lower than its return on equity. As mentioned earlier, value investors prefer to invest in companies with no debt because debt can be risky. If a company has a lot of long-term debt, it can go bankrupt if it faces a sudden problem, risking your investment. If there is any long-term debt on the balance sheet, I like to see the company capable of paying it off with 1 or 2 years of earnings. With $700,000 in net income in 2023 and $500,000 in long-term debts, Tom's Toy Factory can pay off its long-term debts in less than a year. This is it for today, guys. If you got value from this video, feel free to drop a like. And if you want to receive more contents like this, feel free to subscribe. Thank you all and peace out.